Hey guys, welcome back to the channel. My name is Joseph Graff, and in today's video, we're going to be talking about the possibility that there is a bubble in large cap stocks. Before I start today's video, I want to hit you all with a quote. I got $1 million in stash. I stacked my money so tall that you might need a giraffe when you was counting this cash. That was said by none other than the great Young Jeezy, and it really illustrates what we're all about on this channel. Trying to get to that point where we need a giraffe to count all our cash. And with that, let's get it. Alright guys, now that corny introduction's out of the way, we can finally get into the meat and potatoes of this video. So about a week ago, I decided to sell my shares of Apple stock. I had bought them at around $175, and I ended up selling them at about $290. This ended up being about a 60% gain, which I was very happy with. I felt it was time to take profits, and I also thought that there was the potential that Apple had become overvalued. So I was kind of digging around looking for reasons why Apple had done so well over the past few years, and I found this headline. So this headline said, Apple and Microsoft are now worth more than all the stocks in Germany combined. Now, that just blew my mind. How can you have a single company, well, two single companies that are worth more than an entire country's stock market? And, I mean, Germany's a pretty big country as well. So when I hear something like that a single company is worth more than an entire country's stocks, it kind of makes me wonder if there's the potential that there's a bubble. So what a bubble is, in very simple terms, it's when a stock or investment has risen to a point where its current price is unsustainable, and what happens is the price comes crashing down one day. We've seen that in the past in like the tech bubble of the early 2000s, where a lot of tech stocks that were valued very, very, very high all of a sudden came crashing down, lost a ton of value in a very short amount of time. So I kind of wanted to figure out, is this something that could happen to larger stocks like Apple or Microsoft? So the first thing I did is I went and looked at the performance of large cap stocks against small cap stocks. Now, the way I did this is I looked at the two Vanguard ETFs that track large cap stocks and small cap stocks. So the small cap index returned about 55% over the last 5 years. The large cap index returned about 80% over these same last 5 years. So that's about a 25% difference, which is significant. I'm not sure it's enough evidence to say that there is a bubble right now. So I started to do a little more research. Something I found out is that over the past few years, ETF ownership has been increasing rapidly. So a lot of people are beginning to purchase these ETFs that essentially hold a basket of different stocks. Now, there are a bunch of different types of ETFs. You can have an ETF that tracks the Standard & Poor's 500. You can have an ETF that it consists of dividend-paying companies. You can have an ETF that only consists of technology stocks. So there's a lot of different types of ETFs. But something I found is that a lot of these ETFs are weighted by market cap. And what that means is larger companies get a bigger percentage in these ETFs. So the companies that manage these ETFs, they purchase more shares or invest a higher portion of investors' money into these larger stocks. So that kind of got me thinking, is there the possibility that this influx of money into these ETFs that are typically weighted by market cap, could this be causing these stocks to rise artificially high in value, higher than they probably should be, to the point where there's a bubble? And what I mean by this is the stock market follows a basic law of supply and demand. If a lot of people want to buy a stock, they'll bid more for it, causing it to go up and up in value. On the other hand, if people really want to sell a stock, if there's bad news about it or something, people will offer progressively less and less money to get rid of that investment, and people will also offer less and less money to buy that. So the greater demand of a stock, the higher the price will rise, and vice versa. So this is one of the things that I thought could have been a contributing factor to a potential bubble in large cap stocks. Now, after this, I looked at one metric that caused me to realize that no, I do not think there is a bubble in large cap stocks. So I decided to look at the price to earnings ratio of a large cap ETF. So I went and I looked at the Schwab large cap ETF. Right now, it's at about a 25 price to earnings ratio. Now, while this is a little on the higher side, historically, it is nowhere near bubble levels. During the tech crash, the PE ratio was enormous, like well above 50. And even during the last recession, the PE ratio of the Standard & Poor's 500 was very, very high. So at a very basic level, people own stocks because they generate money. Why am I telling you this? Because it kind of helps to explain the reasons behind why a bubble might occur. So a bubble occurs when stocks or investments reach a value, a price that is just unsustainable. Now, what do I mean by unsustainable? It usually means that the earnings of a stock or the growth potential of a stock are minuscule compared to its price. So essentially, everybody is expecting a stock or investment to do really well, and finally somebody realizes there's no way it can meet these expectations and starts to sell. Other people see it to start to decline in value and start to sell as well. So to kind of sum up this video, large cap stocks have increased in value a lot over the last couple of years. There has been an influx of money into ETFs, but I don't think this is causing a bubble, mainly because the PE ratios of these companies do not indicate that they are ridiculously overvalued. These PE ratios are pretty much in line with the Standard & Poor's 500. And while you could make the case that these companies are slightly overvalued, I don't think you could make the case that these companies are grossly overvalued. Stocks like Apple do have a lot of growth potential. Apple just released their new Apple Card. They've been growing their cloud services division. And Microsoft also has a lot of good things going for it as well. Now, I do want to talk to you all a little bit about the risks of owning a very large company like Microsoft or Apple. The biggest risk that I see is increased regulation on these companies. Politicians like Elizabeth Warren have talked about big tech, breaking up big tech, maybe increasing taxes on very large companies. And I definitely think that's one of the biggest risks of owning a large company. Anytime a company has grown to levels like Apple and Microsoft where it's worth over $1 trillion, you always run the risk that there might be new regulations that severely hamper their business model. That's not necessarily a reason not to own one of these companies, but it definitely is something to consider when you are thinking about purchasing shares of one of them. All right, guys, that's going to wrap up today's video. If you liked it, please leave a comment down below. Also, please hit that like button. Please subscribe to the channel, and I will see you all next time.